Hello there, ladies and gentlemen. Karaoke Andy here, and today we will have the third part of the beginner series from curious to confident, and we're going to talk about something that is often overlooked. For this purpose, I have the red t-shirt on because today it's about risk management and the math of a profitable edge. So, little presentation again, but because we're talking about risk, today is especially important that I emphasize the following. Everything here is for educational purposes only. Yeah? I'm not your financial advisor. I am a trader showing how I handle risk. Trading involves real money and real loss potential. Always make your own decisions and never risk money that you can't afford to lose. All right? So, today I will cover the following topics. First of all, the basics. What is a position, stop loss, risk per trade. Then the concept of operating capital. Then stop loss management. We will talk about the math of a profitable edge. The danger of risking too much. We will also talk about risk management for prop firms because that is slightly different. Then we'll talk about all the gurus who promise you a 99.9% win rate and why that is nonsense. And then there will be some takeaways, hopefully. So, a lot to cover. Let's dive in. So let's talk about the basics, right? So, what is a position? That is simply putting on your trade, right? And guess what, ladies and gentlemen? You can not only buy, you can also sell. So, we're calling that going long or short. Yeah? So when you buy the market or when you go long, you make money when the market goes up. Yeah? Probably that's the easiest way to understand, right? You buy a stock at 10, stock goes up, and you sell at 15, you made money. Yeah? So, but you can also take a short position and make money when the market goes down. So let's say stock trades at 15. You sell shorts at stock. Now the stock falls and at 10 you close your position, your short position. You made 5. Yeah? So, what if you're not right? What if the trade goes into the other direction? Yeah. For that reason, we have the concept of a stop loss. Yeah? So a fixed price point that you define per trade. Yeah? Technically, you can also trade without a stop loss, but if you learn from me, I will demand of you that you will never, ever, ever trade without a stop loss. All right? So you always put in a stop loss. That is simply a price that you define where your position will be automatically closed in loss. Yeah? So you go long, you buy the stock at 10, but now it doesn't go up, it goes down. So, and you place your stop loss at 8. Yeah? So, you buy at 10, a market goes down, 9, 8, hits your stop loss level, and your trade is automatically closed for -2. So, you lost 2. And that is your risk. The 2 euros or whatever we were risking there, that's the risk of the trade. Yeah? And that should never be more than, conservatively, 1%, and if you're a little bit more aggressive, 2% of your account size. Yeah. So if you have 1,000 euros in your account, 1% would be what? Would be 10 bucks, right? So you should never risk more than 10 euros on a 1,000 euro account. If it's a 10,000 euro account, well, yeah, then you can risk 100 euros. A 2% risk, that would be 200 euros. Okay, makes sense? Yeah. So this way, if you risk 1%, it takes 100 trades to blow you up. Yeah. And honestly, 4 losers in a row, that can happen all the time. Yeah. And it's also something you need to process mentally. That's a topic for another video where we talk about the psychological aspects of trading, the mental aspects of trading psychology. But for today, we just talk about risk and risk management. So, again, let me draw that for you. What I just said. Look, what is that? Something that I need later. So, anyway. Usually you trade from a chart. And a chart has... What does a chart have? Price and time, yeah? So let's say the market is doing something like this, comes down here, goes up, comes down here, and finds what we call support or a double bottom. You know, I will show you basic market structure and stuff like that. I will show you that in a later video. Yeah. So, well, let's just say this here the price level is 10. Yeah. And now the market goes up, and you think, okay, what if market goes back up here? Yeah. So yeah, you decide to buy, to open a long position. Yeah. So get in here. And now this level here would be 8. And you would say, you know what? It's what retail traders love to do. I'm not teaching you... well, this is about risk management. So just all of you who know already how to run positions, this is just the concept of showing you the basics, yeah? So bear with me. Let's say you put the stop loss down here. You say basically that, you buy here. If the market goes up, great. We are in the money, but what if it goes down? Yeah? At this point, probably that whole setup is invalidated. Yeah, here I want to be stopped out. Yeah. So if that level is 8, yeah, so your stop loss value is 2 here, right? You're risking 2. Now, if your account size is 100 euros, yeah, and your stop loss is 2, you're risking 2% here, yeah? Okay? So, if you wanted to risk only 1%, yeah, so you would either have to put your stop loss here, but maybe you don't want it there, you want it there. So what can you do? You would have to reduce your stake size. Yeah, remember the last video. Yeah. So if you trade at €1 a point, yeah, and you have a 20-point stop loss, yeah, then you're risking €20. If you want to have a 40-point stop loss, yeah, then you know you can't with the same risk still trade at €1 a point. You need to trade at 50 cents a point, yeah, if that makes sense. So okay, so funny enough, but let's maybe show you that on a real broker environment. This is a demo account from Trade Nation. So let's look at the DAX. Let's open up a chart. And I will show you again. I always promise you a later video, right? But bear with me. So this is a candlestick chart. It doesn't need to be a candlestick chart. I will explain to you what that is. Look, we can make it a line chart. Now it looks a little bit like what I was drawing there. So now you see again, down here is time. And here you have price. Right now, the market goes up. We have here a £10,000 account. So that means if we want to risk £100, yeah, so that means we have to define, let's say we want to trade at £5 a point. So our stop loss needs to be 20, right? Because 5 times 20 is 100. So let's buy the bloody DAX. Look, I just hit buy. We opened at 24,292.1 and our stop is at 24,272.1, 20 points lower. So let's make that green. And here you see, now our stop loss is here, is the dotted line. This is our entry. And right now, yeah, we're losing money. The price is not going up. See, we're losing money. This is a live trade on a demo account. Yeah, I'm not risking real money here. It's also funny that this is euros and here it's pounds. Pounds, euros. Yeah. It's actually a similar structure. Price came down, you know, found support here. That could even work if we wait a little. Yeah. So what happens if I close now? I will close at a loss. Yeah. If I wait, maybe this will go into profit. But I also don't want to wait too long. This is a video. It shouldn't be 1 hour long. The guys will sleep by then. So now we are getting slightly into, it was, for a second it was in profit. Okay, hey, we made money. So, that was actually bad trading. Why? Because a concept that's called risk to reward. We'll get into that in a minute. So, now, in the last video, I was talking about margin requirements, leverage, right? You remember that? So you need to have money in the trading account to be able to open positions. Yeah? And depending on your leverage, that margin requirement differs. Yeah. So now, if you have that 10,000 pounds account and risk 100 pounds per trade, and I showed you, I opened a position at 5 pounds a point, risking 100 pounds. So to open up a trade at 5 pounds a point, how much is the margin? Put that in there. Margin requirement is about 607.28 pounds. Yeah? It's probably, no, 527 pounds or 607 euros. Yeah? So, that means you don't need to deposit 10K there, right? You need to deposit there maybe half of that to open a couple of positions, to take a couple of losses. So let's call that operating capital. Yeah, that's what keeps you in the game. Yeah, and the margin is your deposit, operating capital, your buffer. So, but now you could just think, oh, wait a second, I can just max out my margin. Now you have to act, in a way that reflects that your actual account size, even though you deposited just a part of that, a fraction of that, to meet margin requirements, you have to act as if you really have the 10K there. And that's also the money you need to be able to afford to lose. Yeah. So never size positions based on margin. Yeah. Size them on what you can afford to lose. Yeah. Good. I hope that was clear, right? You don't need to deposit there the 10K, but you should have the 10K. That's what I mean. So now stop loss management. Interesting topic. So let's wipe that out here again. How's that work? Let's say, yeah, you bought the DAX here. Put your stop loss here. And now it really goes up. So what can always happen is that the DAX at one point can trade down, right? So even though you were here in profit, that doesn't mean anything. You only realize a profit once you close out, once you close that trade. Now then that money is yours. Otherwise, the position, you have seen that when we were on the demo account, that can go from red to green, right? So it can also go back to red. That's always something that can happen. So that means while you're in a position, you can certainly manipulate the stop loss. What you never ever do when you learn from me, you never move the stop loss back down. You will never ever do that. You will always move the stop loss in one direction, and that is in the direction of your entry. In this case, up. In a short position, the other way around, obviously. Yeah. But let's say we bought here, now price goes up. So we are on the right side of the market. What you can do here, you can move your stop loss up. Your stop loss is at 8, but the market already trades at 15. Yeah, your entry was 10. So what you can do, of course, is you can move your stop loss to 10. That means we are moving stop loss to break even. So what happens now when the market decides to go down again and hits your stop loss? you don't lose anything. Yeah, that's a break-even trade. Yeah, it's a black zero. So the moment you move the stop loss to break even, it's a free trade. Yeah. And now you can, of course, move stop loss further up, yeah, into profit. Now let's say we put the stop loss at 13. So your entry was 10, your stop loss is now at 13. So when the market reverses, price goes down, you will get stopped out in profit. Yeah? So you basically locked in 3 here, right? You bought at 10, you moved stop loss to 13, yeah? And you got stopped out in profit. Again, never move stop loss further down, yeah? Unless you really made a clear mistake, you made a placement mistake and you're correcting that, okay? Yeah, but apart from that, don't do it. Yeah, that's a bad habit. Don't get used to that. The reason is your brain will always try to convince you to you will be hopeful instead of being fearful, right? You will always try to convince yourself, that will go green again, the market will go up again, that will turn around, and so don't even get there. All right. So now, how to make money? When I bought the DAX there, that was just a random trade, right? So I could have pressed sell, and I also could have been on the right side of the market, and for a moment, DAX in fact went down. You have seen that, yeah? So you can't just gamble. You need some sort of system, or what we call an edge, a profitable system that has a statistical advantage over a random outcome. So what does that mean? Yeah? Let's say your edge is to buy double bottoms, right? So when you see something like that, you buy that. Yeah? And maybe you also sell double tops. Yeah? When you see something like that, you sell that. Yeah? So let's say that is what you do. You wait for the market to make either a double bottom or a double top. Yeah? And then you go either long on a double bottom or you sell short on a double top. Okay? So that would be your system. So, and now every profitable system rests on 3 pillars. First is win rate. Yeah, how often are you right, percentage-wise? Yeah. The second is risk to reward. So how much do you make when you're right versus you lose when you're wrong? Yeah? We already covered the losing part. That's your stop loss. Yeah? That's your risk per trade. So now you have to also define how much you will make when you're right. Yeah? So, and then the third aspect is commissions, spread costs, the silent killer, often forgotten, but luckily we covered that in the last video, so you already know that trading costs money. Yeah. So now let's look at a coin. Let's say your edge would equal a coin toss. Yeah? So a coin can either have heads or tails, right? So, and if you throw it often enough, you would either get heads or tails. Yeah? So, let's say you bet on heads. When heads comes, you get 10 bucks. When tails comes, you lose 10 bucks, right? So, and now you flip it. Oh, lost. And won. Wow, cool. So, what happens now? Obviously, you still need to pay commissions, right? So, even though you're technically break even on your system, you still lose money because every trade needs to be paid for. Yeah? So, now let's play a different game. Now let's say you bet on heads. Yeah? And every time tails comes, you give me 10 bucks. And every time heads come, I give you 20. Yeah? So, would you play that game? Of course you would, right? Because we have now introduced a risk to reward ratio of 2-to-1 into our system. Yeah? You make double on a winner than what you risk, right? Yeah? When heads comes up, I give you 20, remember? If tails come up, you give me 10. Yeah? Of course you would play that game. Now, let's say here are 100 coins in that jar, 100 coins, right? And every coin equals 1%. Yeah? Every coin equals 1%. So now we're playing that same game. Yeah? So how much would you bet? Yeah? How much would you bet? If you remember, if you bet one coin, you get 20 if you win. If you bet 10 coins, that would already be 200. So, would you risk 1 coin, 5 coins, 10 coins, 25 coins, everything? So, now here's the thing. If you say you want to risk 25%, yeah, you will go bankrupt. Because statistically, in a system with a 50% win rate, yeah, every 16 trades you will hit 4 losers in a row. Yeah, I repeat, every 16 trades you will get 4 losers in a row. That's statistically inevitable. Yeah, so that's why risk managers, conservative risk managers, they will tell you, yeah, at 1% risk you can take 100 losses, yeah, before you're out, and you won't hit that unless you're trying to. Yeah? So stay out of trouble. 1% per trade. Okay. So now that was the broker example. What if you trade on a prop firm? Yeah. And that's slightly different. So last video I showed you a screenshot of FTMO. I explained to you how that works. So for example, a $50,000 account, simulated account, is a demo account. But still, if you pass the challenges, you're eligible for real money payouts. Yeah, costs you 345 euros. Yeah. So, but here's the difference to a broker account. You can't handle that like if that was a $50,000 account, because it really isn't. That's nominally a $50,000 account, but look at the rules that the prop firms have introduced. Here is a maximum loss limit of $5,000. That's 10% of the account size, right? So that's what we call a drawdown, right? So you accumulate losses, you know, a couple of losers in a row, and the sum of that's the drawdown, right? So, and once you hit 5,000 drawdown, you will lose your account. You will lose that challenge. So you can't handle the 50,000 FTMO account as if that was a 50,000 account. Your real account size when you trade with a prop firm is the maximum drawdown, the maximum loss limit. Yeah, you could even, here's even a maximum daily loss of 2,500. But I would say at least base your risk off that 5,000 maximum loss here. So if you risk 1% per trade, yeah, that's $50, right? So if you risk 2%, that's 100 euros. Not 10 times as much. So that's the difference. If you trade with a prop firm like that, you even have a chance to pass those challenges. All right? So, and now let me take a sip here. Because the next thing is making my blood boil, right? The win rate trap. So fake gurus, they sell you 90%, 95% win rates, you know, all over the place. You see everything there, you know, steal this insane, simple 98% win rate short trading strategy. Elite 98% win rate strategy explained. Don't skip. Much must watch. My God, steal this. Bloody hell. Yeah. So if you fall for that, sorry, I can't help you. Yeah. Look, guys, there is no such thing as a 95% win rate. Yeah. Because you're not, I mean, yes, in theory you can have that. So how do I explain that to you? In my former life, I used to work for a big German corporation, and in an e-commerce department. So this is an example of a different industry, right? So in e-commerce, if you run an online shop, I think you can relate to that. Everything is about conversion rate. Yeah? So visitors come to that online shop. How many of them buy? The percentage number, that's your conversion rate. Yeah? If 5% buy, yeah, then your conversion rate is 5%. So, and then you pay experts, you know, marketing agencies, whatever, and they're all promising you to drive that conversion rate up. Look, here's the thing. I can get that bloody conversion rate to close to 100%. Guess how? Yeah, sell everything for €1 or for free. Then of course everybody will buy, right? Problem is your online shop will go bankrupt. So same with trading, right? So just put there a stop loss that is big enough that you will never get stopped out. Yeah. Or don't trade with a stop loss at all. But once you do get stopped out, yeah, you will blow up. So, and that's the thing. There is no such thing as a 95, 98 or whatever percent win rate, unless you just want to sell something, you know, false confidence or whatever, right? So if you want to trade, I mean, you have to ask yourself, do you want to be right or do you want to make money? If you want to make money, then there is no such thing as a 90, 95, 98, 100% win rate, right? So, okay. There you go. So, let's wrap this up. We're already talking here for over half an hour. Risk 1 or 2% per trade, rather 1%. Use stop losses religiously. Never widen your stop loss. Always move it in the direction of your entry. So trail them forward. Use leverage to control margin. Don't inflate risk. Even if you don't deposit your 10K, that was the example, still you have to trade a 10K account, and that's what you need to be able to lose, right? So, profitable edge has 3 elements: win rate, risk to reward, and cost of trading. And finally, trade to make money and not to be right. Whoa, that was a long one. I hope you enjoyed it. Thank you for watching. See you in the exchange. Karaoke Andi out.